All right, the Paris Olympics are officially in the rearview mirror. But you know what? For investors, the real games are just kicking off. A huge, powerful shift is completely reshaping the French real estate market. And in this explainer, we're going to break down exactly what's happening on the ground. So, the big question on everyone's mind is, what now, right? The games are over, the tourists have packed up and gone home. We're going to look past all that media hype to get to the real story. The deep, structural changes that are creating some absolutely incredible opportunities. And some pretty serious risks, too. Okay, first things first. The most important thing you have to get your head around is this. There is no such thing as a single French market anymore. It's literally splitting into two, being pulled apart by some really powerful economic forces. And what this is called is a K-shaped recovery. It's a really simple but powerful idea. Imagine the letter K. One arm is shooting straight up. Those are the parts of the market that are absolutely thriving. But the other arm, well, it's plunging straight down. Those are the assets that are facing a real crisis. There's no middle ground here. It's a market of very clear winners and very clear losers. And check this out. This map just illustrates that divide perfectly. Look at the top right corner, that thriving green box. You've got Paris, of course, and the PACA region. That's the French Riviera, for those of you keeping score, just humming along with strong economies and tons of international buyers. But then, look down at the bottom left, the distressed red zone. We're talking about rural, disconnected areas where prices are actually going down. The takeaway here is crystal clear. Location and connectivity are absolutely everything right now. All right, let's talk about the Olympics, because this is where things get really interesting. Most people, honestly, they completely miss the point. They thought it was all about a 2-week party, but the real prize was something else entirely. So you had all this hype, right? The media was promising this massive tourism boom. But the reality? Well, France's own Court of Auditors reported it was a tiny, and I mean tiny, 0.07% bump to GDP. So what happened? Well, it's something called the eviction effect. Basically, regular tourists just stayed away, scared off by the insane crowds and prices. Get this, museum attendance actually went down. Now this chart, this tells the real story. See that yellow line? That's the short-term tourism cash. It's flat, a total bust for anyone who was hoping to make a quick buck. But now, look at that blue line shooting up. That is the permanent value created by new infrastructure, especially the €36 billion Grand Paris Express metro system. See, the Olympics were just an excuse, a catalyst to force through decades worth of urban upgrades. And that, my friends, is the real long-term prize. And if all that wasn't enough, there's a new force in town, and it's reshaping the market with, frankly, brutal efficiency. I'm talking about strict new green regulations. Yeah, welcome to what they're calling the passoire thermique crisis. That translates to thermal sieves. Basically, any property with a really bad energy rating, we're talking F and G ratings, is about to face a rental ban. It's already starting. As of January 1st, 2025, you can't rent out a G-rated property, period. And this is causing a huge sell-off. These homes are trading at what's called a brown discount, sometimes up to 25% off, as landlords just panic and try to get out. But, and this is where it gets clever, hidden inside this crisis is a brilliant opportunity for arbitrage. You see, the government is quietly changing how they calculate that energy rating, the DPE. For years, it punished electric heating. But starting in early 2026, the math changes in its favor. So think about it. You could potentially buy a G-rated apartment with electric heating at a massive discount in 2025, do absolutely nothing to it, and then just wait. When the new rules kick in, its rating could automatically jump up to an E or an F, making it legal to rent again. Boom. Instant value unlocked. This decision tree lays it out perfectly. You spot one of these thermal sieves. First question you ask, what's the heating source? If it's gas or oil, you're probably looking at a big, expensive renovation. But if it's electric, you follow that green path right to a potential arbitrage play, all thanks to that 2026 reform. This isn't luck, it's a surgical, knowledge-based strategy. So, all of this brings us to the big question, the ultimate strategic choice every single investor in France is facing right now. In a market this divided, what do? Do you go for aggressive cash flow? Or do you bunker down in the safety of a blue-chip fortress asset? Well, if it's yield you're after, you have to start looking at France's so-called Rust Belt cities. I mean, look at these numbers. Mulhouse is delivering a staggering 11.3% gross yield. Saint-Étienne is right behind it at 11%. Now compare that to a big popular hub like Lyon. which is considered a great benchmark at just 4.3%. The difference is, it's just incredible. It's a different universe. In this slide right here, wow. It really puts that choice into sharp focus. On one hand, you've got Mulhouse. You can buy property for about 1,400 euros a square meter and get that insane 11.3% yield. On the other hand, you have the 6th arrondissement in Paris. You're paying over 15,000 euros a square meter for a yield of around 3%. This is the ultimate trade-off, isn't it? Aggressive cash flow versus pure, solid wealth preservation, what the French call patrimony.
But you know what the really smart money is doing? They're not choosing one or the other. They're doing both. They're using that powerful cash flow engine from a place like Mulhouse to actually pay for and protect their fortress assets in Paris. It's a brilliant strategy, really. You're making your money work hard for you in one place to secure your long-term wealth in another.
Okay, last but definitely not least, we have to navigate what is maybe the biggest minefield of them all. I'm talking about a seismic shift in French real estate taxes that's coming in 2025. You see, the super popular LMNP tax status, it's not the simple tax haven it used to be. Now it's more like a double-edged sword. On one side, you've still got this amazing income shield that can protect your rental profits. But on the other side, there's a brand new capital gains trap just waiting for you when you decide to sell. Now that shield is still incredibly powerful. Don't get me wrong. It works through something called amortization. Think of it as a phantom expense. The government lets you deduct the theoretical wear and tear on your property from your rental income. So what's the result? Well, you could have thousands of euros in real cash hitting your bank account every year. But on your tax return, your taxable income is zero. Pretty sweet, right? But here comes the trap. In the old days, all that amortization you claimed, it just disappeared when you sold the place. The tax man just ignored it. Well, guess what? That loophole is now slammed shut. The old strategy, buy, use amortization to pay zero tax, then flip it for a profit a few years later, that game is over. It is completely finished for short-term holders. So what's the damage? It all comes down to this one number, 36.2%. That's the new exit tax rate. When you sell, every single euro of depreciation you claimed over the years gets added back to your profit and then taxed at that painful rate. So basically, every euro you thought you saved on income tax is now coming back to you as one giant bill. But there is a way to diffuse this trap, and this chart shows you exactly how. The secret is time. Time is your best friend here. You see, in France, the capital gains tax you pay goes down the longer you own a property. Just look at that red line, the new tax rate. Yeah, it's brutally high if you sell in the first few years, but watch how it drops over time, falling all the way to zero after 30 years. So what does this mean? It means the trap is really only designed to catch short-term flippers. If you're a long-term buy-and-hold investor, this whole reform basically becomes a non-issue when you sell. So let's just pull this all together. What are the key takeaways? 1. The French market is no longer one thing. It's split in two by that K-shaped recovery. 2. The real Olympic prize wasn't 2 weeks of tourism, it was decades of infrastructure. 3. Those new green regulations are a double-edged sword, creating huge risks but also some clever opportunities. 4. Investors have a very stark choice to make between high-yield cities and Parisian fortress assets. And finally, 5. The big 2025 tax shift is a game changer. It punishes flippers and really rewards those who are in it for the long haul. Look, this is a market that is no longer forgiving. You can't just be a passive or uninformed investor anymore. And that really brings us to the final critical question you have to ask yourself. In this new landscape of such clear winners and losers, which side of that K are you going to choose to be on?